Joining us now is Goldman Sachs Asset Management Public Investing CIO, Ashish Shah. Welcome, Ashish. It's nice to see you.
Thanks, Sarah. Thanks for having me.
Wanted to actually start with the action in bonds today because the 10-year yield is below 260, and this is your background, your expertise in fixed income. We're seeing a greater inversion of the curve. What is the message right now from the bond market?
Look, I think the bond market is telling you that we're seeing slowing growth and decelerating inflation in the marketplace. And so, the market believes that the Fed is priced in getting tight, but knows that that tightness is going to actually slow the economy, and down the line that we're above the neutral rate. And so I think what we have to gauge is what are the types of returns that we can get by buying bonds where easing is priced in. I'd much rather be buying those higher yields. We were almost 100 basis points higher about a month ago. And now the risk return is looking a little bit less good out the curve.
But do you think we've seen the highs for bond yields this cycle?
I think we've probably seen the highs out the curve, but in the near term, we certainly could see more hiking. And in fact, I'd expect more hiking from the Fed as they go from neutral to tight.
So do you think the market overall, stocks, bonds, has gotten ahead of itself when it comes to a Fed pivot and potentially easing next year?
Look, I don't think the market has to have gotten ahead of itself here. I think that the market's acknowledging the fact that they do have risk priced in, further hikes priced in, over 80 basis points of hikes priced in from here to the end of the year. And equity markets have rallied as a function of simply having less uncertainty. We were talking about 4 or 5% interest rates. There are folks that were talking about inflation that was out of control. I think what we're finding is that the Fed is being effective in its forward guidance and its hiking cycle. And so that's part of the reason why markets have rallied back in. Have we gotten a little bit overdone in the near term based on technicals? Probably. But I think that kind of just reducing the amount of volatility has been constructive for both bonds and stocks in the near term.
So what is the signal for, beyond just the very near term and the technical move that we've seen, what is the signal for stocks that you're getting right now as it relates to this question about recession and the Fed cycle and everything like that?
Yeah, so take a look at what's happening today. You have the cyclicals or deep cyclicals getting hit. That's partly as a function of the weak data that we got over the weekend. And I think as we go forward, the real question is going to be, can we keep from going into a deep recession or bounce out of a really shallow recession? Or are we going to see follow-on shocks that really limit the growth of the global economy? And I think the bottom line is no one knows this, right? Like no one can actually forecast. But we've priced in some good risks into markets. And I think that you can earn some good income given how high rates have gotten in the near term and how much risk premium are priced into equity. So we're definitely seeing good opportunities across equity, credit, and frankly, even bonds. All you have to do is not sit in a bank account that's earning zero, because there are plenty of those out there. Cash is trash.
But cash flow is key. I know you think. So Ashish, where is the best entry point in terms of equities? What types of sectors or types of stocks?
Yeah, so the things that we think are kind of really interesting here, I kind of point to the growth space, which has really gone through a lot of consolidation. I think a lot of folks are hiding in kind of the bellwether names, the largest caps in growth equities. And I think that maybe a little bit too much has been priced in on the back of strong earnings. So where we see opportunity is in the software sector, where we think there's just a secular trend of software eating the world, and where mid caps represent good value to capture real growth. We also see a lot of value in biotech, where they have very robust research pipelines, and at the end of the day, a ton of cash that they're sitting on. Granted, they're burning it to do that research, but we think that there's going to be a lot of M&A in that space going forward, and it represents a real opportunity for active management.
People have been waiting for that biotech M&A for a while. Ashish Shah, we'll kind of leave it there. Thank you for joining us.